here it is. Last week you mentioned a mortgage price, which is what a habit I tend to use. I tend to refer to mortgage rates as a mortgage price. And the question is, isn't getting a mortgage all about rate? What does the term mortgage price mean? Well, I want to go ahead and explain that and get into some detail, because it can be somewhat of a confusing subject, but at the same time, I think it'll give you a better grasp of how mortgage rates are offered and what your options are if you're getting a mortgage. Now, I would say that the price of a mortgage includes the interest rate plus the what we call discount. Now, what discount means is you can have discount points, what that means is there's going to be some points or money charged up front to get a corresponding lower rate. Your next choice, which is the most common these days and has been, really for several years now, is to look for the best or lowest rate with no points. And then the third option is looking to get a rate, the best rate you can with no points, but maybe also to get a rate that's a little bit higher than market in order to get a lender credit in addition to not paying points. So on this rate grid that we have here that Jeff put together, I'm showing you, and I pulled this up a couple of days ago, and I'm showing you a rate range from 7 to 8% on the left side of the grid. Next to that is the APR. I'm doing that because, of course, I'm sharing interest rates with the general public on this program. So it is required that we give you an APR to go with these rates that you're seeing on the left column. Now, the discount column, that's the most important one in order to establish or to illustrate to you how there could be points, no points, or no points and a lender credit for a particular rate chosen. When you look at this grid, I would suggest that the market rate, the rate where the market is demanding a yield, is right around in the middle there, about 7.5%. You can see the discount price is 100.125. Well, what that actually means is at that rate, which was 7.5, and if we had locked it a couple of days ago when I put this together, the price or the discount price would have been no points, and the borrower would have gotten a rebate of 1/8 of 1% of the loan amount. And that's what you see on the right column all the way to the right. That column is points/rebate. So the market rate on this grid at the time I put it together was about 7.5. Now, understand that when you lock in a rate, let's say you did have a borrower lock in that 7.5 rate. In reality, on the day that rate lock is executed, that borrower actually has a choice of any of these rate and discount cost combinations on the grid. In other words, if they locked at 7.5 for 30 days at a price of 100.125, that's no points, plus they're getting a small 1/8 of 1% rebate from the lender. Well, let's say they're into their purchase escrow and they end up negotiating a deal with the seller to offer some credit that can be used to buy down the rate. Well, then, because we already locked the rate at 7.5, we could then revise the rate lock to the lower rate, let's say all the way down to 7. What happens there is you're now going to see that the price is no longer going to be 100.125. It's going to drop to 98.25. Well, that's a bond price. What that means is to get that 7% rate, there will have to be 1.75 points charged for that rate. And remember, a point is a 1% of the loan amount. So in this case, 1.75% of the loan amount, or 1.75 points, that would be the charge for that 7% rate. And as I've always argued, if you were going to do that, you're best served to get that cost, that 1.75 point cost for the lower rate, that buy down rate, get that paid for by the seller. Now, in some cases, what we'll run into is a borrower who's good on income, their debt ratio is fine, but they're challenged on down payment. They're unable to negotiate a seller credit to either buy down the rate or to pay closing costs. So sometimes what they'll do, or they'll ask us, can we finance the closing costs somehow so we're not paying them out of pocket? Well, that is possible, and that's the other part of this grid. If you've already locked at 7.5, but let's say you decide you want to reduce your actual net cash closing costs, then what you can do is revise the rate lock and take a higher rate. For example, let's say you took the 7 7/8 rate. Well, if you took that rate, not only are you still not paying any points, you're now getting a rebate from the lender of 1.125% of your loan amount. Why is that? Because the 7 7/8 rate is above the current market rate by 3/8%. So if you're willing to close the loan with the lender at that higher rate, even after the originator is compensated, you've got leftover funds that you, the borrower, essentially own, and you can apply that towards your other third-party fee-based closing costs like escrow fees, title fees, appraisal fees, credit report, et cetera, et cetera. So this is a good example of how when you lock in a rate, you're not really locking in one specific rate, but you're locking in a combination of different rates and discount, either points or no points, or a net lender premium if you're locking in or changing your rate lock to a higher rate because you want to get those dollars and apply them toward other closing costs. So this is what I mean when I say a mortgage price. Just understand that when you're locking a rate, there is no one rate. You're actually locking in this entire grid. And in some cases, you may need to move the rate that you locked in at for the reasons I just described. And this would give you this shows you how that can be done and what the numbers are that is involved. So I just wanted to show you this and clarify why mortgage price is a little bit more detailed than you might think. But I think this could be helpful to you. Either if you're contemplating getting a mortgage on a purchase and maybe looking to buy down the rate, gives you an idea what the costs are to buy down that rate permanently, as well as how can you extract some net premium from the lender to pay your closing costs if you bump that rate up.